Hi, everybody. I'm going to be moderating and presenting this presentation by myself today. So I'm going to be a little distracted with trying to get to your questions. And so if you can, please ask questions in the Q&A. I will read through those and I'll try to answer them as best as I can while also presenting. The good thing is that I think this presentation is going to be fairly short. This is just a kind of a mini topic that I wanted to highlight. And hopefully this is a engaging back and forth Q&A. Feel free to ask as many questions as possible. I am not a tender exchange expert or QI. I just help people find a good tender exchange opportunities and tax advantage strategies. All right, 6:04, we'll begin. Hi, everybody. My name is Eng Taing. As most of you guys are probably repeat visitors, my background is in economics and finance. I used to work at Apple most recently, and I'm CEO and founder of Total Capital. I have also been a real estate investor since 2009 and used tender exchange strategies to great effect for many of my investments. And this is going to be quite a short deck because I want to just get to the point, talk about what tender exchange is, some other alternatives, and the particularities of tender exchanges into a syndicated or a partnership investment, as we just did one recently, and we're helping some investors do one now. So just want to talk about the basics of a tender exchange. Tender exchange process is pretty simple. Essentially, what you do is you identify a qualified intermediary, and if anyone needs any referrals for qualified QIs, I'm happy to provide that after, or just reach out to us. List your property, and then you find replacement property within 45 days. There's some restrictions on the identification of that replacement property. You have to find 3 properties within those. You don't have to find 3. You can find up to 3 properties in those 45 days. And then you have 180 days to then replace that property. So fairly easy timeline, but one thing to note is, and I went through this example in real time a few months ago. If you sell your property and it doesn't go to a QI, then it does not qualify as a tender exchange. So just make sure that when you prepare yourself into a tender exchange, use a QI, start that process way before, and then when you close the funds, you can then, the QI then holds an escrow and then sends it to the replacement property. So pretty simple tender exchange. And I want to just take a pause here and talk about why you do tender exchange. I think one of the biggest things I've talked about in previous presentations is the power of optimizing capital. And oftentimes optimizing capital means selling something and moving into a better, higher yield entity. For my parents, for example, I have been trying to sell all their California properties that have appreciated fairly well in the Los Angeles area, but have at this current rate, based on the cap rates of those properties, are trading at a 3.5 cap or 4 cap, which means that their cash and cash returns are very low. And because they have so much equity built up, the loans are low or even non-existent at this point, they have so much equity yielding so few returns. And that's a really great example of something that you could definitely use a little bit more returns, because that's all we're trying to do here. We're trying to optimize the capital. There's 2 ways you can do about doing that. And the one way that we've done it oftentimes is a cash out refinance. You basically take a cash out refinance and you up your loan balance. You get a 3% or 4% refinance or HELOC, and then you redeploy that into another investment. But tender exchange does something very similar. And you can then take the cost basis of that property and transfer it to the next property. And so that's a really great way of optimizing capital and sort of just moving from lower yield to higher yield, which will get you to your financial freedom goals sooner. And I think I presented this in the past. One thing that I love about 1031 exchange is the deferral of taxes. And real estate in general has been a lot about deferring taxes. When you invest in properties, you can cash out, you can get cash flow. Hopefully you can cash flowing properties. And then you can do a 1031 exchange. Now, in between, you're also getting depreciation. The depreciation potentially doing bonus depreciation, and you're reducing the cost basis. So as I want to just walk through this in a little more detail. Imagine you bought $1 million property. You have a cost basis of $1 million, and over 10 years, you've taken $200,000 of depreciation. That property now has a cost basis of $800,000. If you sell the property for $1 million, meaning that you essentially bought it for $1 million, you sold it for $1 million, your profits would still be, you would actually have a profit of $200,000. That would be classified as a depreciation recapture, which is actually taxed at 25% long-term capital gains rate. Of course, there's always a little bit of puts and takes here. If you do any home improvements, that adds to the cost basis. If you, all the closing fees adds to the cost basis as well. So it's all about how much of your profit, and depreciation is a reduction of profit and a deferral of taxes, or deferral of profits, really. But the more common thing is that you're not buying something for $1 million, you're selling for $1 million. You're buying for $1 million and you're selling for $2 million, potentially. And now you have a very large capital gains event. So you can take the 1031 exchange, as I discussed, do a cash out, move that cost basis of $800,000 from the first $1 million to another property at a larger property, maybe it's $3 million property, and then you keep doing it until potentially the property you have is at a zero cost basis. And of course, if you do this correctly, and if you keep doing this, your cost basis is so low and your profits would be so high if you ever sold, that it would be disadvantaged to ever sell. So that's why people keep doing 1031 exchanges. But ultimately, if you pass away at the end and you set it up correctly, it passes to your heirs tax-free, and your cost basis gets stepped up to fair market value. So if you started with $1 million property, now you have a $20 million property, and your cost basis is zero because you've been transforming and rolling that cost basis to continue to the next property, and you've been taking the benefit of appreciation of real estate. That $20 million property has zero cost basis with $20 million of taxable capital gains, if ever sold, gets stepped up to a $20 million cost basis. And now if your heirs sell it the day they receive it, they owe no taxes on the capital gains. An investor asks real quickly, what is a HELOC? It's essentially a home equity line of credit. And I talk about line of credit all the time. There's so many different types of lines of credit. SBLOC, which is a securities-backed line of credit. You take a credit line against your security, like an Apple share, and you can take a HELOC, essentially a line of credit against your home equity. I find it very hard to ask questions in back and forth. Is it possible for the cost basis to go negative? I don't think so. I think it can only go to zero, but this is a good question that I'm not 100% sure of. I'm pretty sure that's the case that can't go negative. This is where being not a CPA is not as advantage from. So, we talked about 1031 exchanges, and one thing that people might not realize is that you can actually 1031 exchange from a property that you own and into a partnership or a syndicated partnership that essentially somebody else manages. and cash flows for you, like any of our potentially TOSI capital deals. And that's a huge advantage because a lot of times people are tendering exchanging from a property they own to another property, not because they're not selling the property because they they want to get higher yield. They're selling the property because it's a pain to manage something themselves. It's not something they want to do. It's not something they like to do. And then the thought of buying something else, you're essentially doing the same thing. So what is a TIC? A TIC is a tenant in common, and it allows essentially a tender exchange to then tender exchange into a partnership, a tenant in common partnership, where you have essentially two more investors own a property and have fractional ownership of the property. We recently helped, I believe it was 7 investors in tender exchange into one of our partnership properties with Shahid, Hampton Manor Sunday. It's a beautiful property, cash flows very well. And a lot of our these investors had cash flowing properties. One of them was actually my parents. Give you a real example. They sold their property for around $400,000. They had around $100,000 of loan. They had around $300,000 of proceeds. And what they were receiving back then was around $1,000 a month net after all the mortgage and interest. So not really a high yield on the return, around 3% on cash and cash. And they were able to now get a significantly higher 12% cash and cash return and not have to maintain it or do anything. So we were able to help around 7 people tender exchange into a TIC, tenant in common, in our most recent property, Hampton Manor Dundee. And we're actually helping a few more do the same in the end of November. Okay. So I'm going to pause here and ask. I'm just going to keep going. This is where like having a moderate probably help. So TIC rules, I'm not going to go through all these because I don't know how relevant it is. It's just a little bit of copy paste from the web, online, but just want to highlight a few important ones. You can't have more than 35 in a TIC. So you can only have essentially 35 owners. And it has to be, you can't file a partnership tax return. Essentially, you own it like any other property. You just have a specific title of it. You have a fractional title of a property. And there's a few more rules, but mostly it's around the fact that there's a little bit of interchangeable rules where you can't intermingle loans and whatnot. I do want to highlight a few other tender exchange options that you guys might not know about. One is the reverse tender exchange, because sometimes the timing of selling and buying might not fit. You might want to buy something and you might want to sell your property to buy the property. Maybe you don't need to sell the property to buy the property, but you want to still tender exchange it. If the timing doesn't work, you can still do a reverse tender exchange by essentially purchasing the property, and within 45 days, identify the property to sell, which is the property that you potentially intended to sell. And then within 180 days, complete the sell. So a reverse tender exchange still works, applies the same. Not as familiar with it, so in terms of the details, but there's something that a few people have done that I know as well. Another thing that I want to highlight is what we call a drop and swap. And this is something that TOSI Capital and our investors who are utilized on occasion. Essentially, for some of our smaller syndicated investments, where we have a few partners in an LLC, which almost all of our investments are structured as an LLC, and we have limited partners. And potentially, if you have around 20 limited partners, and myself as the manager or TOSI Capital as the manager, we could tender exchange by essentially dropping our LLC, split it up, and then essentially title ourselves as tenants in common, and we all exit the LLC. We now are titled. We all have the proportional deed of the title, and it now looks like a ownership versus a partnership, that a single partnership that owns it. And now you can do a tender exchange going to the next property. So that's how potentially a few of our investments and a few of investments that I've been in do the tender exchange from a passive investment, a syndicated investment, into their own thing, or just leverage the tender exchange rules of that deferral taxes. Still the same rules apply around the timing. A little bit more complicated, but drop and swap, basically dropping that partnership into a deeded tenant common, and then swapping it just like any other tender exchange. Another topic that I think I have vigorously researched and I still somewhat confused about sometimes is DSTs. And I want to highlight DSTs because this is a much more common way for investors to invest into essentially a partnership or passive investment. Delaware Statutory Trust essentially is a good way to essentially replace a property into a grouped investment. In this case, you can do 499 investors into a DST. And that DST essentially has a trustee, and there's a sponsor or affiliate, whatever it is, like myself potentially, and then essentially manage a property for the real estate investment. There's a couple of differences from the tender exchange to the DST. Most of it means just generally higher regulations and fees, typically because of the different types of structures and complexities of it. But it does offer itself a little bit more flexibility. But there's actually a lot more potentially DSTs if you ever want to sell your property and we don't have a tender exchange that can help. I guess we mostly do tender exchanges. A DST could be a good solution for you. And I want to highlight, I believe this is the last slide. I want to highlight another option for tender exchanges is opportunity zone. When you sell property, you have 180 days to exchange into another property, but maybe you don't want to do a tick and you don't want to, or you can't find one, or you don't want to go into another property yourself. You can do essentially a very similar method of essentially taking the capital gains portion of that sale of property, including the depreciation recapture, and deploy it into a opportunity zone. And this does have some advantages. It's more flexible. The advantages of an opportunity zone is that it steps up in basis after 5 years. So you do pay 10% less tax, but you do pay the tax. Unlike tender exchanges, which has, if you keep deferring it, you could potentially never pay the tax. Although for the opportunity zone, once you pay that initial tax, all future taxes, capital gains on the opportunity zone is eliminated. And of course, for tender exchange, if you keep doing it, you don't have to as well. And I think the biggest thing here is that it's a bit more flexible. And some people have asked me, should I do a tender exchange? Should I do a opportunity zone? Really, I think really it's about how much profit do you have on the property. If you're selling $1 million property and your cost basis is $900,000 and your equity is around $500,000, you essentially have $400,000 of equity, or $400,000 of cost basis, and then $100,000 of profits. You're going to have to take the whole proceeds into a new project, a new property, and potentially that ratio, that 20% of the profit ratio, might not make sense of your money. An opportunity zone allows you to have a little more flexibility. You can essentially take that on a profit portion, use that equity, that 400K that I mentioned, on a bunch of different properties, because you don't pay taxes on that anyways, and just invest that capital gains portion, which might be a smaller sliver of that proceeds, into one opportunity zone or many opportunity zones. And of course, Toasted Capital has an opportunity zone investment. I believe we're actually about to close ours, or have closed our senior living investment We are working on a blockchain data center slash Bitcoin mining opportunity zone, and hopefully we'll highlight that in the next few weeks to our investors before the 2021 deadline of that 10% step up. Essentially, if you invest in the opportunity zone before the end of the year, you still get that 10% step up in basis, meaning 10% less taxes after 5 years. But if you invest in an opportunity zone in January 1st, 2022, that's eliminated. You don't have that extra benefit. All right. Hopefully that was a very quick one. I'm going to now. It was probably very hard to ask like a Q&A, and it's very moderated. Really helps. So I'm going to go to questions. So bear with me while I read these questions. I joined a little late, but I want to sell a bunch of stock with higher gain and invest in real estate and avoid paying taxes for gain. If you want to sell stock, opportunity zones are a perfect method to defer those capital gains. Real estate, 1031 exchanges is like kind property. So real estate to another real estate. It does not allow for capital, essentially sell a stock. Although there are clever lawyers and accountants that can leverage a DST, but I'm not, have not researched that. But an opportunity zone is a really good way to defer capital gains on that. I have done 1031 exchange in the past, but not pay attention to cost basis. Is there a special setup needed? Not really. I think the way that cost basis is tracked is you have depreciation schedule. Every year you've been filing taxes, and you have whether you're putting in a home improvement, which increases the cost basis, or you're taking depreciation, which reduces the cost basis. And by the way, you have to take depreciation because the IRS will assume you're taking it anyways. That depreciation schedule should help you identify how much depreciation you've taken on that property, and that will help you understand what your cost basis is from when you first initially bought it. So you should have your buying closing statement from when you first bought it, and then all the tax returns in between, or just understand how much improvements you've done so that you can add to the cost basis. Can we just do the capital gains to 1031 exchange, or do we have to hold sales proceeds? Good question. So you don't actually have to 1031 exchange the whole thing. I believe you can 1031 exchange just a portion of it, but you have to get larger loan amount at the very least, or the same or larger loan amount. And so you have to have the same or larger property. So in general, most people do take the whole capital gains, but sometimes you do you can 1031 exchange into 2 properties. If we move 1031 funds into one of Tozi's offerings, when the offering sale ends, do we then need to keep rolling those proceeds into an offering? No, you don't. Now, essentially, ultimately, you might have to pay taxes. Not that bad a thing. That just means you made a lot of profits. There are other solutions to reduce your taxable income: land conservation easements, solar credits, etc. But I think keep rolling over is a good idea. How we get cash flow from that project is the fact that these rollovers helps you build a bigger capital stack. And if your cash and cash is the same throughout, you're just continue to have a higher absolute yield, even though you haven't actually done anything throughout the whole time. So you could get more money monthly as you continue to move over to the next investment. Is TIC allowed in all 50 states or some states? I don't know. I haven't seen that question asked or that mentioned specifically, so I would guess not, but it's a question I haven't seen, which means that probably it's not a thing. Otherwise, it would have been like addressed before, so I can't answer that. From your experience, is it possible to tender exchange from property outside of the US to property in the US? I have not had that experience. I do know that you can tender exchange into foreign properties and from foreign properties to US properties. I do not have personal experience on that. Although, tender exchange expert that I've been following recently is Bill Exeter. He has some pretty good talks on YouTube that could help. Can you talk about like-kind? I didn't think I could change multifamily into something like Hampton Manor. Yeah, so like-kind is just means it's a income-producing property, real estate asset. Like-kind doesn't mean that it has to be a single-family house to another single-family house, an industrial property to another industrial property. Could be a single-family house into industrial property, because the single-family house is creating income, and that industrial property is creating income. And so these two are like-kind in the IRS tax code. So you could actually take your single family house, buy a data center or a bowling alley that creates renter income, or a senior living facility like one of ours. So that's like-kind exchanges. Can we defer capital gains incurred from sale of stock by investing in OZ? Yes, I think I answered that earlier. But that's a really great point. I mean, a really great, OZs are really one of the only ways, easy ways to defer capital gains from sale of stock by investing in OZ. Remember, you have 180 days from when you sell to invest into an opportunity zone. I believe we have one open or closed. Don't remember. It might be closed. I think it tells them our team to close it. But we will have one before the end of the year, which is an important milestone here, because one of the rules of an opportunity zone is that if you hold it for 5 years before December 31st in 2026, you essentially get that 10% step up in basis, which means that essentially if you had $100,000 sale of Apple shares and your cost basis is $50,000, that $50,000 gets stepped up by 10%, so that when you actually pay taxes in the future, 5 years in the future, it will look like it was a $55,000 cost basis, and now you have a $45,000 capital gain, so you pay taxes. The net effect is that you pay 10% less taxes. But it's that December 31st deadline is hard-coded, which means that by the time you're in January 1st, if you're investing in an opportunity zone, you do not get that 10% step up in cost basis or 10% reduction in capital gains. So definitely look into an opportunity zone by the end of the year if you're really looking for that, though still beneficial to invest afterwards. And Tozy Capital will be opening one up hopefully soon. So what's the point of tendering exchanges from a tax perspective? What behavior is the government trying to motivate? I think the motivation here is that, well, the biggest motivation is that if government wants to continue investments, and one of the actions of tendering exchanges is that it allows people to continue to invest the capital, right? It keeps capital invested and it keeps moving capital around. It does not invest. A lot of the tax code is about the incentivization of investing. While that's maybe not the best thing in terms of investment class and versus who can invest, it still is about deploying money into communities, into into cities, into neighborhoods that essentially will allow potential revitalization and improvements. And so tendering exchange usually is about the government not wanting that money from a sale to then go into anything else versus continue to keep reinvesting. What is the advantage of a TIC over regular property purchase or a tendering exchange? So in the reframe of a TIC of what I was discussing is that a TIC allows an investor to essentially come into a partnership, have a manager, still manage the property, and essentially act very similar to syndicated passive investment. It's not passive. By law, it's not passive, but it feels very much so. It is very much so. And essentially, you can actually even do a tick with a syndication. So you could have a Tozy Capital syndication that's a regular LLC where investors can come in as members, limited partners of the LLC, come in with another seller who investor who sells their property from a tender exchange, and then tick tender essentially into the property where we essentially have two titles. You could have multiple. So you can actually have two syndications come in into one property. Essentially, each one would have different titles and title deeds. And the advantage really is about scale. You can buy something bigger, and you can and a little bit of passivity. Although by law, it's not passive, as my CPA told me. You can't say that. Is there a way to avoid deferring taxes when RSUs initially vest? That's a great question, not related. So when RSU vests, you're essentially paying ordinary income taxes. And essentially, if you were getting 100 Apple shares, they will sell 45 Apple shares for you, and now you get 55. Not great. I'm not sure if there's like I believe there was some way to essentially edit that, but it might be outside my scope of immediate knowledge right now. Are there any options to hold proceeds beyond 180 days? For example, like buying replacement properties after a year or so? That's a good question. Now, one of the things that happens is the 180 days expires. Can't do an option zone, can't do a tender exchange. What happens? The one thing that I've seen people do, and I've done it myself, is you just buy something bigger, hopefully, and you take a very large cost segregation study, and you get a very large tax depreciation, essentially a big passive loss for that new investment. Because when you invest in something, you typically get depreciation. And if it's a new thing and you're doing cost segregation study, you're pulling forward a lot of the 10 and 15-year useful life property, which is generally around 20% of an asset value. So if you're buying something for $1 million, say the land is zero, you can get a $200,000 loss. And if you're paying only 20% down, now you got a 1-to-1. So essentially, you put $200,000 down, you get $200,000 loss. And if you sold property that you maybe made $200,000 of profits on, took the $200,000 of profits, bought this new property or invested in the property outside the 180 days, but within the same calendar year, now you're essentially offsetting that capital gains. So you're offsetting capital gains from passive losses. So that neutralizes essentially looking at, it has to be in the same calendar year. Cryptocurrency is considered property in the eyes of the IRS. Is it possible to apply tender exchange to selling and buying crypto? It's a great question. There needs to be a lot of clarification with cryptocurrencies, and I will wait for the clarifications before I volunteer to ask those questions myself. Empty piece of land. Land cannot be, land has no cost basis, or land cannot be depreciated. So can you tender exchange land, exchange from one land to, I think it should be an income producing property. I'm not 100% sure it's like kind if it's just empty piece of land. So I don't know. So I do have a expert attendee here who says, yes, land can be exchanged. So yes, land can be exchanged. And she says, no, only real property can be exchanged, which probably refers to the cryptocurrency. So I don't think so. Does Tozy plan to have tender exchange offerings on a frequent basis throughout the year? Yes, we do. And oftentimes our analysis of tender exchange offerings versus say a income fund offering is, are you guys asking? Now, if Kathy, if you're asking us or anybody asking us, can I do a tender exchange? I have something I'm selling, and oftentimes we're just trying to help. And if we were planning to do this as a syndicated passive investment, we were going to buy it anyways. We were going to manage it anyways with our partner Shahid or any of our other investments. It's like a little bit of a puzzle piece, right? We're looking for capital. We're looking to provide yield on the capital for investors. And that capital could be tender exchange money, could be syndicated passive LP money, could be both as well. Some of our investments in the past have been offered to both, although it's easier if we have enough tender exchange funds to essentially just do a TIC tender exchange offering, and that's typically what we've done. But I would suspect that next year, while we do probably twice or 3 times the number of real estate acquisitions, that oftentimes we will have investors ask us, do you have something for a tender exchange? And we will try to help. And if you fit into the puzzle, then that we can accommodate the time schedule. Because I think the reason why a lot of times we don't do tender exchange, for example, for Maple Haven, I felt bad that I could not help some investors who wanted to tender exchange into Maple Haven, was because we had a specific time schedule to close by. And TICs, tender exchanges, typically take a little bit longer. So if you know you're selling and you know you have 45-day deadline and 180-day deadline, just let us know. We usually have a calendar of different acquisitions we're targeting. So this will help us plan and give you some prior warning of like if you want to tender exchange into one of our future investment properties. Yes, so the question is back to another question on the vesting RCVest. So when you get your taxes on RCVest, that is ordinary income. I don't know how you would defer that, because that's ordinary income tax. Essentially, they're giving you a bonus in the form of RSUs. That's how it's classified, and bonus is classified as ordinary income. And of course, the appreciation of that RSU afterwards is capital gains. Can you sell multiple single-family homes for one multi-family or commercial property? Yes, you can. So you could yourself do a TIC from three properties, single-family homes, and then into one larger property. And I'm not 100% sure, because I haven't actually seen that, whether you're essentially going to have 3 titles or you merge it. But I'm not going to try to guess. But I definitely know that that's possible. Question on the drop and swap. I have some passive real estate syndications now. What do I need to do if I want to do a tender exchange down after the exit? Does the current syndication need to be structuring for me? Generally, yes. So most syndications do not offer drop and swaps, primarily because there's a lot of investors. So if there's more than 35 investors, it will be impossible to drop and swap everyone. If there's a little bit less investors, then it becomes easier. And if and it takes a lot of coordination amongst investors, because everyone essentially has to sign a bunch of documents. Now you're owners, and it's a lot more headache for the syndicate. So it has to be carefully planned in advance, and it has to be structured in a way. And so usually it's better done with a smaller set of investors that have potentially bigger capital gains, and that this would be advantageous even with the higher administration burden. What is the IRC for depreciation, passive losses to offset capital gains? I thought passive losses can only offset passive gains. Can you clarify? Yeah, when you sell property, that still is classified in that realm of passive gains. And when you sell a property and you buy another property, and you essentially have a big loss you can apply that to your gain from that property sale. Is it possible to do a 1031 exchange of a single property to 2 or more? I think I answered that. No, that's the other way around. You can do from multiple to 1, and you can also do from 1 to multiple. Yes, you can. Essentially, you would identify 2 properties, and then I believe you can, and split the proceeds into 2 properties. I've done this. I've seen a few people do that, especially when you have a very large property and you want to get into potentially smaller properties or different type of asset classes. Since we have to take depreciation and I end with a tax loss, can we carry forward the tax loss to the next year? Yes. So if you're not like me and trying to optimize your taxes all the time and defer, if your property is not cash flowing, then you really have nothing to offset, and you're getting a tax loss because of the depreciation. Or if you're essentially taking a big depreciation and the next year selling it, essentially it's a neutral benefit. So depreciation or any losses can be carried forward indefinitely into the future to offset future gains. And one of those future gains would be when you sell it. So potentially it would be a neutral event where you essentially have a loss, but you have a gain. The loss was from the gain was from the loss, and then you essentially just neutralize each other. Hopefully that makes sense. What happens if 180-day deadlines miss? Any legal ramifications? Yes, you just can't do the 1031 exchange. The QI then provides, deposit that money back in your account, and now you have to pay taxes unless you unless you invest in something else in the same calendar year, get more losses. And the same effect happens when you buy or invest in a land conservation easement, essentially getting more losses or reducing your taxable income. So you should think about your taxes as a P&L. You have profits and losses, and you're trying to balance it out. And of course, the losses hopefully is paper losses or deferred losses that can balance the actual real gains. All right, with that, no more questions. This is intended to be a mini presentation, so I really appreciate everyone attending today. We do have a current 1031 exchange offering that we're going to be sending everyone. Have to manage Adrian, and we're going to have that in the email when we send that to you guys. And on occasions, we will have offerings that will be 1031 exchange eligible, but my hope is that you guys just ask us, let us know if you have something. We're here to help. If we don't have anything, we're here to refer, or we can potentially put your capital gains into an opportunity zone, which generally might be slightly easier. Anyways, it's a bit weird to talk to yourself the whole time, but I appreciate everyone coming tonight on Thursday evening. And thank you, everybody, for attending. Have a good night.